Welcome to Retire Right Television. It is a great day to live on the beautiful Mississippi Gulf Coast. I'm Rebecca Powers here with Paul Roberts. Good to see you, Paul.
Oh, it's always great, Rebecca.
It's always great to see you because I sleep very well at night, my husband and I, knowing that we are in very good hands. I want to share with everyone a way to strategically win in these tumultuous, kind of scary times with, of course, inflation and stock market and everything that we're seeing. You give me such peace of mind and all of your clients. Let's share with our viewers at home who are not clients yet a way to strategically win in these what could be difficult days.
I think the most difficult thing for your average person is to adjust ideologies and philosophies at the right times, right? Especially when you've been in a 13-year bull market. You know, but it's been great. And people start thinking in that growth mentality, that performance mentality, that bullish market, that, okay, well, it's okay, it'll always be better, it'll always be better. We have left that bull market.
Yeah.
And I know they're playing wordsmithing games, you know, in Congress and everywhere, and it's not a recession, it's a transition, this and that.
It's so ridiculous.
We're in a full-blown recession. Yeah. Let's not sugarcoat it. We're in a full-blown bear market. You're going to see little bear market rallies and spikes like we did there, you know, in August. We had a nice little run back up in the market, but you see now it's falling right back off. And those one of the biggest fear is people have not shifted their mode of thinking from bull market to bear market, and they don't really understand market cycles, okay? And so every time they see a little leg up, like in August, okay, it's okay, the pain's over, it's coming back.
And recovering.
No, boom, then you get hit again. But get past that, understand we're in a full-fledged bear market and a full-fledged recession. But it's okay, okay? It's okay. You know, like we say, or a lot of any of the great entrepreneurs and the biggest billionaires and greatest economists in the world will tell you, a bull market is good for making money. But real fortunes are made in a recession.
Explain that, because that's fascinating. That's a strange idea.
Fortunes are made in a recession. Fortunes were made from the dot-com bubble, okay? Fortunes were made from the 2008 financial crisis. Fortunes will be made in this recession. I have no fear of this recession because my thinking shifted almost a year ago from, okay, bull market cycles to bear market cycles, recession. And so when you shift, everything changes. The whole game changes. You have to shift modes. You have to shift how you're thinking, how you're strategically planning, how you're positioning, right? For instance, you know, fortunes are made. Do you know how many real estate billionaires came out of the 2008 financial crisis?
I don't, but it kind of makes you angry, doesn't it?
Well, yeah,
unless you're one of them, I guess.
Right. I mean, you can't get mad at people for winning, right, and being smart. You know, and the whole point is these were people who saw things right, understood market cycles, and they knew the name of the game sometimes is just not losing. Okay. Sometimes you win big by not losing big, right? That's the name of the game now. One of the biggest shifts people have to make mentally is their expectations. Okay. They've been in a bull market for 13 years. They have bull market expectations. You don't need to have bull market expectations in a bear market in a recession. You need to have the direct opposite. You shouldn't expect the performance in the returns because there's no way to get that return or create those performance numbers, right? Instead, we have a philosophy like I referred to when we're talking in the public. I tell people the philosophy today and right now is last man standing. Yeah. Okay? So last man standing meaning you win big by not losing big. Whoever doesn't participate in all the loss during this recession are the ones who are going to be able to take advantage of the recession, and that's where fortunes are going to be made. If you hang in there and you take all the old financial double talk, right? Yeah. Oh, it's okay. It's just a paper loss. The market always comes back.
Ride the roller coaster.
Yeah, which are true. You know, true statements. The market does always come back, and it will eventually. But how old will you be? Right. And how many years of your life did you waste riding it to the bottom and waiting for it to come back time? Right. So when you get into a recession and bear markets, what the whole point is not to have wasted performance on recovery time, right? I don't want to be in the market when it's at the bottom, because guess what? When I have not lost any money and my clients haven't lost any money on the downturn and the market's at the bottom, guess who gets to buy it dirt cheap?
You.
Yes, all the people who didn't lose. Sometimes winning is just simply not losing. And right now, that's the name of the game. Don't lose money. Hold on to what you have. You don't need to have these big expectations. You don't need to go spend a bunch of money and live lavishly. You got to understand, sometimes it's time to just hunker down and get through the hard time, prevent losses, prevent spending too much money, and be the last man standing, the one who still has their money and their money's available. When the real estate market's at the bottom, when the stock market's at the bottom, we're going to be buying it up. Okay?
Gotcha.
But the people who participated and they took that old financial double talk of, that's okay, the market always comes back. True, it will, over a 5 to 10 year period.
Right.
But now you spent 2 years in decline, and you're going to spend 4 to 5 years in recovery.
And you still won't make back the entire amount because you taught me about compound interest.
6 years of your life is gone, and people don't understand opportunity risk. If you lost 3 to 6 years of your investment opportunity time by riding it down and riding it back up and going through all that recovery phase, you missed out on all types of opportunities that me and my clients are taking advantage of. Because we understand right now, don't lose money is how you win. You know, that's how, like, for instance, we were talking off the set and personally about some things. What do we do now? You know, we have some great products out there right now. We have some great short-term, like 2 and 3 year MYGA annuities that are just like a CD, and they're paying like 4 and 4.5% right now.
Yeah.
And sometimes you show somebody that and you're like, hey, look, we can make a secure 4% for the next 2 years.
And not lose.
Not lose. And they're like, yeah, but my portfolio, I want my portfolio to make 8 to 9. Yeah, but you're not understanding the market cycles and where we are. You're creating unrealistic expectations for yourself, and that's why you're going to fail.
And risk. And that's why part of your plan, the holistic plan for each individual who comes in, is really a risk evaluation. I don't think half the people even know what their risk is.
No, they don't. Or they think they do. And they come in, oh, I'm not that much risk. And then we do evaluation. They're like, oh, my God, I got a 60% downside? Yeah. I didn't know I was at that much risk. I told my broker I didn't want to take much risk. Right now is not the time for risk. It's the time to say, I'm going to lower my performance expectations. I'm not going after this 8 to 10% return. If I can just make a secure 4 and constant 4 or 5, somewhere in that range, if I make 4 to 5% over the next 2 years while everybody else is losing money in the market,
That's right.
and I maintain what I have and I don't lose any, then all of a sudden when the market's at the bottom, it's okay I only made 4% for 2 years. Because now I get to buy the market cheap, like we were talking about before.
Gotcha.
Right? I get to buy real estate at the bottom. I get to buy stocks at the bottom. Now I just enjoy the ride up. I don't have to waste all those years in recovery. I don't have to waste all those years on my health. And then people need to think about that too.
Right. And when you're 62 years old, you're thinking about, am I going to retire or am I going to wait 6 to 10 years for the market to recover?
Right.
When you're 72 years old, I'm sorry, unless you're incredibly healthy, it's very difficult to start over.
Well, that's why people need to watch the financial double talk. You know, when we first enter the industry, when you're a rookie, the first thing you're taught in training is financial double talk. Oh, it's not a loss. It's only a paper loss. It's not a loss until we sell. Well, how long are we going to wait to sell? Right.
Right.
The markets always come back. Over time, the markets always come back. That's true. But that's a statement for a 25, 30-year-old.
Right.
That's not a statement for a retiree.
Right.
Okay, yeah, the markets always come back. But are you going to spend a year or 2 in decline and 3 to 4 years in recovery? Well, there went 5 years of your enjoyment of retirement. There, and if you took income, which most retirees need from their savings, the whole way your account was declining. So say the market goes down 40%. Well, if you were taking income withdrawals the whole way it declined 40%, you're down, a lot greater than 40%.
Wow.
Now your recovery is even greater. And there's no chance that you're ever going to recover and get back to square one where you were. So those financial double talk statements of, the market always comes back, those are for statements for long-term investors. And retirees sometimes confuse themselves with long-term investors. Why am I in this for the long run, for all of my retirement? No. A long-term investor is someone who has a long period of time, 10, 20, 30 years, that they don't need the money.
Right.
If you're 25, 30, it's okay. Right. 35, okay. I don't need it for 20 years. I'm good. You can ride it up and down. You can ride it wherever. But a retiree is usually not in that position. They need those assets. They need those savings to create their income.
And enjoy the rest of their
And enjoy the
retirement
rest
that
of their
they've
life.
earned.
So those, don't take
Yeah.
that financial double talk once you're at retirement.
All right, Paul, we need to take a very short break, but I want to talk about annuities and some of those really safe tools when we come back. So stick around and give them the number for me, please.
228-388-2031. Give our office a call right now. We've got 20 spots open for our viewers on the television show. Pick up the phone, give us a call now. Let's get you set. Let's get you on track. You deserve the confidence in your future.
Absolutely, and really, you will experience the Roberts Wealth difference. We will be right back. Stay with us.
Meeting our son.
Crazy road trips.
Memories with Grandpa.
Family and friends.
My first job.
My fourth job.
Exploring our world.
Our world. Our first date.
Our
Our special song.
Secure your retirement by meeting with a financial advisor.
Hey folks, let us help you make your retirement dreams a reality. Give my office a call today.
Do you know how much you're paying in fees or commissions with your current plan or advisor? What about unnecessary risk or future tax implications? Sit down with a fiduciary advisor who can help you understand important retirement concepts and so you can make the best decisions for yourself moving forward. We may even be able to answer questions you didn't even know needed to be asked.
Hey folks, what's your next move? Let's get you set to retire right.
Welcome back. I'm here with Paul Roberts. I'm Rebecca Powers. So wonderful to be with you all. We were talking about safe ways, and I love this. And I actually asked you to do this for me in June. You said, calm down, it's not time yet. And then in July, you said, wait. And it corrected. It's stunningly amazing how you can look at the markets and tell that. But you were helping me move to annuities, and that is safer. What are some of the other safe tools? And there are different types of annuities.
Yeah.
Let's be clear about that.
That's right. Well, you know, traditionally in the world of I'm putting my money in a non-risk asset, let's call it, you know, you got to be careful with the language in our word in our industry there.
Less risk.
Right.
Safe.
A non-risk asset is traditionally been, you know, a bond, an annuity, a CD, treasuries, things of that nature,
Okay.
right? One of the difficulties that we've had as money managers and the difficulties that people have had out there as investors is, well, when the market's acting up and it's so insecure and so volatile and I'm scared of it, where do I go? So do I move my money to bonds? No. Bonds are at just as much risk as your stocks right now. You know, we're going to watch the bond bubble pop over this year.
Oh, wow.
As bonds have inverse relationships to interest rates.
Huh.
So the time to buy bonds was from 2009 to 2015. As rates were falling, your bonds were gaining value, and we killed it on bonds for about 4 years there. We didn't hardly touch the stock market. We were making double-digit returns in bonds for about
Good.
4 years. But then when rates got to the bottom, that was when it was time to stop buying bonds, okay? And anyone, I'd go out and venture out and say something bold here. If your broker advisor has sold you a bond since 2015, they have not done what's in your best interest. We haven't put a client in bonds since 2015.
Wow.
Because you want to be in bonds in a falling interest rate environment. Once we got our interest rates to all-time lows and bonds are paying 2 to 3% and we know rates have to go back up, it's time to stop buying bonds, okay? Move on to another instrument. So if your advisor sold you a bond since 2015, it was not in your best interest. It was one of two things. Either they were ignorant of the situation and they didn't really understand how bonds work and how
Yeah.
yields work, and that's kind of a scary thought, right?
Right.
If
Or they were
they're-
the big bucks and they were forced to because that's their product
or
list.
they
Am I
didn't
right?
care and they wanted to earn their commission anyways, which is even worse, right?
Right.
But it's got to be one of those two scenarios.
Right.
Because anybody who wants to do what's in your best interest and is knowledgeable enough to understand markets knew that you should not be touching bonds since 2015.
Yeah.
So we had to do a major shift at that time. Now, previously we have always used some annuities, so going back to since, you know, before 2008. 2008, before the last financial crisis, we saved a lot of our clients a lot of money by moving a lot of money out of stocks and into annuities. They didn't suffer those losses. They've done great. And those are the clients that love us to death, right? And we're making a whole new big group of those clients today in this new recession.
We should do T-shirts for us. I was in that group. So, no.
But that was previously. After 2015, when interest rates hit the bottom,
Yeah.
we knew the bond game was up. You can't buy bonds because as rates start to come back up, the inverse relationship is going to devalue bonds. So we said, all right, well, what do? And we started looking heavier into fixed index annuities, and we found what we think is an incredible product because we are in an environment now where rates are increasing. Well, for bonds with an inverse relationship, that's going to smoke bonds. However, the fixed indexed annuity, it gives you security. It protects you against downside in the market. However, as interest rates continue to increase, it's a positive effect on the indexed annuity. The indexed annuity has rates and percentages they pay you inside of the market gains every year. Well, every time rates increase, all of those rates go up. So people get too caught up in investments or the name of an investment, a stock or a bond or an annuity or a mutual fund, and a mutual fund's good and an annuity's bad or a bond's bad and a stock's good. What people need to understand is there is no good and bad in investment vehicle world. They are the right product at the right time
For your individual
for your
situation
individual
as well.
needs, and it's positioning of market cycles, right?
Yeah.
Like I said, from 2010 to 2009 to 2015, we were using bonds like crazy. That was the time and the place to use bonds.
Yeah.
Since then, we haven't used bonds. We've replaced it with the fixed index annuity. And people say, I don't like an annuity, a bond's better. No, a bond's better when it's time to be in a bond.
You like annuities right now if
And
you're watching the
annuity's
news.
better when it's better the time to be in an annuity. And now is the time for the annuity.
Yeah.
And people need to wrap their minds around these things and say, hey, it's not about what you think or the connotations that go with the word. It's understanding that all investment vehicles are tools. They're designed to achieve specific jobs. And that job, first you have to determine what is the job I want my dollars to do. What are the goals and what do I want them to do for me? And then you say, all right, these are what I want to do for me. Then it's easy to look into the bag of tools or investment vehicles and say, okay, this tool is the one that does that job.
You mentioned mortgage. Can we go there?
Yeah, sure. Mortgage.
You said something about mortgages, and it made me remember that mortgage rates, we were all refinancing a few years ago when mortgage rates were very, very low, and then it kind of halted. People thought it would never go down again, but you kind of said, wait, I think it's going to inch down again, which is remarkable. Explain that, and why did it do that?
Right. I mean, I give personal examples. And I know you and I had the same discussion on refinancing our homes and things back in June.
Yeah.
I was looking to refinance some properties, and I said, no, let's wait until August, September, and we'll get a lot lower rates. And the mortgage broker was like, no, rates are going up. You better do it now. Well, of course they want to earn their commission now, right? and you're thinking, well, but the bankers and the mortgage guys are saying rates are going to go up. No, they're not. That's because they don't understand economics and market cycles. It's what we refer to as the inverse yield curve, right? So the inverse yield curve used to be a real big indicator of recession. Today, they say it's not, although we're in a full-blown recession with an inverted yield curve.
With a different name.
I think it's a pretty good indicator.
Transition?
Right, but it's a transition now. It's not a recession. So the inverted yield curve philosophy is wrong because we're not in a recession. We're in a transition.
Yeah. Okay.
Whatever you want to call it, it's accurate. Okay, it's an accurate indicator of where we're going.
So inverted yield.
Yeah. So inverted yield. I'm sorry. Sometimes I say these things and I forget that a lot of people don't understand. So
That's what I'm here for.
Okay. Inverted yield curve is when, the yield curve is the difference or the separation in yield from short-term yield to long-term yield.
Okay.
So another where it's comparing the 1 or 2 year treasury to the 10, 20 year treasuries, right? So you think, well, of course, they're going to pay you more the longer you're in something, right? And that's typically true. A 10 year is going to pay you a higher yield or a higher rate than a 1 or a 2 year, right?
Okay.
Well, when they come to situations in our economy when that yield curve becomes inverse, and that's when things start to change and shift. That's when recessions happen. That's when everything starts to happen. So basically, now we're in a place where it's crazy, and people look at it and they're like, wait, the 1 year Treasury bill is paying a higher rate than the 10 year? Yes.
That is.
Because they don't have enough confidence and certainty in the 10 year and where we're going and how they're going to curve inflation. And so that 10 year is paying you lower, whereas the Federal Reserve is increasing rates right now so that the 1 year is paying you a higher rate than the 10 year. And that's why we knew not to refinance our mortgages back in June.
Right.
And that's why, with that day we were talking, you said,
Yeah.
no, my mortgage banker said rates are just going to go up from here. I said, yeah, but he doesn't understand economics.
I was starting to panic with everyone else.
The yield curve's going to invert more, and the
Right.
10-year Treasury is going to come down. And as the 10-year Treasury comes down, mortgage rates are going to come back down. And that's what we see happening now. People wondering, why are mortgage rates coming down? It's the inversion of the yield curve.
So I'm going to ask, we're going to take a very quick break. I'm going to ask you to give that phone number and tell people what they can expect. Complimentary, no obligation, no fees, like literally just leave your checkbook at home, but tell them what they can expect when they come in.
Sure. Well, Rebecca hit it on the head. Leave your checkbook at home. It's not going to cost you anything to come sit down with us. And you know what? Do us another favor. Leave your fears and anxiety of making financial decisions at home, because when you walk in our office, there's not going to be any pressure sales. There's no one going to try to sell you a timeshare and make you think it's the end of the world if you don't buy one. Okay, we have an amazing team of all-star professionals who are there to help you find your way to and through retirement. All they do all day, every day is retirement planning. They understand every aspect of building a holistic retirement plan, meaning we're going to look at your portfolio, we're going to do analysis on your fees and commissions, we're going to look at your risk tolerance. What does your downside look like? We're going to build out an income plan you can depend on. We're going to give you inflation protection, tax protection. Then we're going to look forward into your family and your inheritance and estate planning. By the time you come out the process, you will have a fully comprehensive plan for the rest of your life and know where you'll be in 5, 10, and 20 years. Now, I know a lot of people sitting at home right now watching this are going, I have no idea what we'll be in 5, 10, 20 years because everything's so uncertain and I'm so scared right now. Tell you what, when you walk in our office, do me a favor, leave that fear at home. You're not walking into anywhere that's fear-driven. You're walking into a group of people who have your back, your best interest at mind, and they're going to show you how we've helped over 2,000 clients rest and sleep assured at night. You deserve the plan that gives you the confidence to know where you're going. So come on in, give us a call, come sit down with one of our all-star advisors today.
Absolutely, and the producer said we only have about 16 spots total now, so please give us a call before we come back so we can get you a reservation. Stay with us, more with Paul Roberts right after this.
At Roberts Wealth Management, we are passionate about making sure our clients live stress-free in retirement. Our biggest fear when meeting with new clients is whether it is too late to fix other advisors' mistakes. When you're nearing retirement, it's essential that you have a written plan and know exactly how that plan will work. Many consumers are loyal to their current advisors instead of the success of their plan. Always get a second opinion. For a complimentary review, contact us today. We are frequently asked, what's more important in retirement, having a great plan or working with a great advisor? The answer is that both are vitally important to your retirement success. Retirement planning is not just a one and done, which means that even the best plans will need to be adjusted. That's exactly why you need an experienced partner to guide you on the journey. Are you confident enough in both to seek a second opinion? Contact us today for your own complimentary analysis.
Welcome back to Retire Right Television. I know when you thought of the name of this, Paul Roberts, you said Retire Right because that is your hope and dream for everyone in South Mississippi. Imagine how great our community would be if everyone retired right. What is your definition of retiring right? Let's just end the show today with that.
Freedom, right?
Amen.
Money, the only purpose of money is freedom. And I think too many people in society today have got the purpose of money misunderstood.
Yes.
They think it's for material objects or for
Impress people.
Boo,
who
or
cares?
make them feel secure about themselves.
Right.
To me, the only purpose of money has ever been is freedom, right? You ask all the time on the show, how do I live so calmly and relaxed? Why do I not stress? And why do I not live a life of anxiety? Because I enjoy every day of my life because I live free. Because when I was a young man, I saw money as the only way to truly find freedom in the systems of society today and say, if you want freedom, you got to make the money. How are you going to make the money? To make the money, you got to understand money.
That's right.
And I started to learn to understand money, and I worked hard, and today I have freedom. I'm here doing the show with you because I choose to, not because I have to.
Yeah, you just flew in from your island, we know, and you look tan and eating fresh fruit, and you have achieved your dream. And I think the other thing about you and your team is that you give back.
Yes.
You know, constantly giving back. You've got the success because you're not greedy, number one, but you always give back. Let's briefly, 3 minutes left in the show today, but I want to hit on some of your charities. People don't even know half of what you all do.
Well, the biggest one, and I hope everyone at home, you know, if you're a client or you can come to one of our events, bring some cash on you, because we're going to call you out. We call out every client at every event. We say, hey, I happen to know a little bit of insight into your personal financial situation.
You can afford this.
I know you can afford to give $20 to $50 to a great cause here, okay? But the biggest charity that we have been supporting, because we've just fallen in love with the purpose, and it is called SOS for America, and is created by a dear friend of ours who just does amazing work. He's an angel. He's a veteran, and he helps veterans. So what we do is we help suicidal veterans. These are guys who have lost limbs, lost everything. They're on their last straw.
Yeah, I've seen friends killed next to them, suicidal.
They're ready to go. They're suicidal. They don't have a hope left. And we come in, and we don't do it. Our funding does it, but they come in and they take these guys and they help them. They give them a new life. They give them a new purpose. For instance, last year we sent 6 of them on a 4-month tour around the U.S.
On a bus, right?
We put them in a big, beautiful, luxurious RV. They went on a tour. They went to all the national parks. They went to the Special Olympics and participated and trained.
Wow,
they did all of these things. And the most incredible part is when they come home 3 or 4 months later and you meet these guys and you see them, and they were people who wanted to take their own life.
Yeah.
And now they have a new purpose. They're out helping other veterans. They're helping other people who felt that way. And I mean, they're changing lives, and it's amazing. And my client base is so awesome because they help us change lives.
Absolutely.
And they change lives for the better, and it's just a really great thing to be a part of. So
yeah, it is.
support SOS for America. It's a great, great cause, amazing group of individuals, and we love them. And we know where every penny's going.
Absolutely.
And we know every dollar and every penny is going to the cause.
It's not administrative.
It's not going to some administrator's pocket or some CEO's bonus or salary. So it's really going there. So we love and appreciate it.
I love that. And of course, Toys for Tots, and the list goes on and on. But SOS for America is really the thing that I think drives you the most, chokes you up, and me too. So 40 seconds left. I'm sorry, y'all, we're already done. I feel like I could talk to you for hours about this. And join us every week right here, wherever you're watching us, because we're kind of all over now. Paul, get that number one more time and just invite our friends to give us a call and come on in.
Yep. As Rebecca said earlier, don't forget there's limited slots available every week when we do this show. Most of them have already probably filled up. So pick up the phone, give us a call today. If you're sitting at home with any fear or anxiety, there's no reason to. Choose to not participate in that lifestyle they're trying to create. We don't participate. We live, love, and we live life happily. You can too. Come in and see the All-Star team. Let us show you the way.
Absolutely. Thanks for joining us. We'll see you next time.